Hello, good afternoon. My name is Tarmo Karotam, and welcome to the Q4 Baltic Horizon webinar. So let's start. I see quite a few people have joined over the past few days. Received several questions, and I hope to answer those questions also during the presentation. And if something I have missed, then please don't hesitate to ask your question in the Q&A section. So let's start with the general overview, and I would say that 2022 for us was generally still a good year considering the circumstances and the tough environment that we have been operating in. So several new events that were not forecasted to happen happened, and the fund, having been partially from recovery mode from COVID restrictions, had to cope with other new challenges, but I think overall we achieved a good result, and definitely the key words from 2022 were increased energy costs for us, as well uncertainty among some of our retail tenants. So and as well listing in Stockholm that we had to restructure, and of course refinancing of several of the fund loans, and that has been the focus of the fund already for a couple of years. So overall, if we start with the refinancing of the loans, then the banking sector is working well, and we have, as a long-term client of several banks, been able to successfully extend many of our loans. And if you ask me about conditions, then the conditions are quite similar. And what we have also done now over the past several months is to aim to increase some of our loans. And that's what we did see maybe a change was that amortization, which we didn't have before. As you know, our capital structure from previous periods since 2018 was amortization free, and that was the main goal of the fund, to have net cash flow at the maximum level. Also, we introduced a bond for that purpose, and lowered the bank loans LTVs, and were able to generate high cash flows and pay out a high dividend. So we just calculated, and since listing, we paid out almost 50 cents per unit in terms of cash return for the investors. And so if one joined the investment into the fund in 2016, then over the years, also during the COVID years, we paid back almost 40% of the investment. So, but times have changed, and I think everybody knows that we have a bond maturing in spring this year, and the management also for the past I would say year has been working on the bond, on refinancing the bond, and I will get into more details later on. But overall, I would say that the actions that have taken place within the fund and are taking place now also this year, especially before spring, are mainly focused on getting the new capital structure for the fund the next 3 to 5 year period. One notable event, just to mention here as well, we have a new board member at the management company of Northern Horizon Capital, our long-term employee Edvinas Karbauskas. Edvinas's background is from Ernst & Young and also having been a fund controller of the fund. So he knows all the numbers and the nitty-gritty details by heart, and is focusing also on financing projects, but also investment projects as we go along. And a note as well that Algis Vaitikunas, previous board member, retired, and but I think we will see him still around, potentially in the supervisory board of the fund for the coming period. And yes, we mentioned here as the website, which has been a part of a longer rebranding process to make communication more clear, to make our website more lean and clean, and to align also Baltic Horizon's logo to the different logos within the Northern Horizon Group. As one may know, we have several other funds in the Nordics, healthcare funds. So it has been a branding exercise that has taken place for some time now, but it is completed now, and we live under the new signage. So let's get into more details. There's been quite a few specific questions about the properties, so I will try to answer them. But I think one notable event at the end of last year, on the last days actually, was selling the parking house. It was a negotiation that took almost 4 to 5 months, and we had several interested buyers, and we owned the 50% of the parking house. So if you haven't been there, then the parking house is behind the Europa Center, and it was built in 2004, owned 50-50 by Europa Office Tower owner Hanner and their prime location property fund. So when we acquired the shopping center back in 2015, we inherited 50% of the parking, so we were operating the parking together and had some space for our visitors. But of course, the structure was amortized and is getting older and older, so we had some disagreements on how to renovate the house, the parking house, and what should be the future of the parking house. And when an offer came from the other party to sell 50%, and we thought it was a good idea. We of course made sure that we have available parking places for our customers, and regardless that the change was now that from the first hour parking is payable, because that was previously, it was one of the few places in the city center of Vilnius where parking was still free. Then it is a promotion that also for our tenants, and that people, if you really come and park there, then you're expected as well to shop and then you get the parking for free. So I think the conversion has been quite successful. We're also happy to deleverage, with the sales proceeds. So that has been also the main focus of the fund for the past 6 to 9 months. And second transaction, which we prepared already end of last year, was a sale of Domus Pro in Vilnius. It's a neighborhood supermarket which we developed together with a local developer back in 2013, 14, and 15. And there's been a few questions why Domus Pro and why nothing, why Europa Parking and why G4S, for example, in 2021. So since already the COVID times, we have been internally discussing a lot, about the future of Baltic Horizon and where we want to be, and now we've actually started to execute some of these transactions. So when we consider our disposals, we think about several things, and one thing is, of course, the tenant mix and the footfalls and attractiveness of certain property and location for the coming period. The second thing is as well, the amount of investments that certain properties would need in the coming years when certain lease agreements are coming to an end. So with putting these into numbers and looking into what we should dispose and where do we see potential and where do we don't see that much potential in terms of, for example, rental growth, then those decisions have been made vastly because of that. So we are focused on making our portfolio more and more efficient, and believe it or not, we still believe in city centers. So regardless of COVID, which was of course a big black swan back in the day, but what we see is that city centers continue to be very vibrant, and just wait until the tourists are back. So in that sense, focusing our investments more into city center areas, and that's why also we believe that the investments that we've made into some of our assets over the past years have been successful and will merit good results in the coming years. Maybe last comment here is that we held the property for close to 9 years and developed it and eventually bought it from the developer quite an attractive price, and it has been a good cash cow for the fund, allowing us to earn a double-digit return, doubling the money. But yes, I think the key reason for selling this, apart from preparing to refinance the bond, was that these type of properties are amortizing, and there are lots of investments needed in this property in the coming years. A few words about the tenant mix. So substantially, the largest tenants haven't changed, and there was also a question on how do I see the office market today? Are the governmental companies, are they decreasing space, becoming more efficient? So I think my answer hasn't really changed. What I see is that companies are operating in their premises. Yes, home office is partially already the new reality, but there's a lot of replanning of office space and for group works, for team building exercises, and so on. And as I've said also before, I don't think there's a major sort of push for a large expansions of certain tenants, but I also don't see that there is a major push for large reductions of larger tenants. Even though there has been some, also in our case, one example, the Lithuanian tax authority in our North Star during COVID times reduced their space by 1,000 square meters. But we've, installed a sort of small office hotel there, and now it's fully let to smaller tenants. So I think, it's still quite a normal scene what I see. So I don't see major expansions, but also not too many major contractions as well. And from this list, SEB, our tenant in Upmalas bureau in Latvia, is the one who is actually expanding, and that's the reason why, and expanding heavily. So that's the reason why they have decided to move into a new development on the other side of the river in Riga. So by the second half of this year, they will be moving out. But it's an attractive property, very well. Let's say the floors and the terraces are in very good state. So we are already in negotiations with a couple of potential new tenants. We will meet one in Riga next Monday to discuss for that tenant for 2,000 square meters. So we do see, still quite an quite active office market. The tenants are moving, expanding. Some are reducing space, but yeah, quite a normal market. Then more specifically about our properties, one by one, a few comments. In Duetos, there's been some reshuffling of tenants, some expanding, some retracting. So, but overall, the properties remain fully let. The small vacancy there is related to the kindergarten and a small cafeteria downstairs in Dueto 1, but otherwise well performing two office properties. In Europa, there's been also quite a few questions that the recovery of the NOI in Europa hasn't been as fast as expected, and it is true. So we have put a lot of effort into rejuvenating Europa, not only how it looks, but also morally, to bring a different vibe. It used to be opened as a fashion center, but it's definitely not a fashion center anymore. It's a service center, and to make that conversion has taken time, but the plan is set, and you have visited the property. There's quite a few new tenants. The food hall we've talked about is a lot, and that's a big success. And also we have Avitela, which is now more of a gadget electronic shop, Odore and Amore, which is a makeup store with a bar, very successful. Kurakan, Ali, the cafeterias, and I would say that the strategy of Europa is definitely to bring more services and to bring more food and beverage, and we are in negotiations with a day spa as well. So there's quite a few new tenants that are coming, but it just takes time to implement the agreements and bring them in. But so if one asks, why we don't have a major new fashion anchor there, then that's not our focus anymore. Yes, we want to have some fashion and some clothes and garments for the customers, but it's definitely more services, it's definitely more F&B, and that's based on the questionnaires of which have been done for surrounding offices with the people in the surrounding offices. So if you would look at our three top assets in our city centers, Postimaja in Tallinn, Galerija, the centers in Riga, and Europa in Vilnius, then they are, yes, very centrally located, but they have quite a different catchment and audience. So in Europa, definitely the people working in the surroundings, but also living, but mainly working, not so many tourists currently. And historically, that may change in the future, but it's not the most touristy location. Whereas Galerija centers, main audience is the people living in the old town, working in the old town, government sector, students, but also definitely tourists. And in Tallinn, Postimaja catchment is people visiting the city center, working, living here, but as well tourists. So it slightly differs what the different customers of different centers are looking for. There will be many things happening in Europa this year, and we're working to recover the NOI, and the new leases. The new lease levels have been 20-30% higher than we signed before. So all the new leases that we've signed, the concepts are working, tenants are happy, customers are happy. So I think that's very good feedback for us that we are on the right track. Then Domus Pro, as I mentioned a bit, there's we're selling this property. There are several leases, large leases expiring there, and some investment needs, and we had an offer on a table. Actually, we had 3 offers on a table, so it showed as well that the investment market is quite active also during these times. And North Star doing well, and Meraki, we have fully finished the property, and some tenants have moved in. Currently, we have just recently signed another lease agreement with Baltic Line, so occupancy now increased to close to 31%, and we have several discussions ongoing as well with tenants. So it's a matter of time when I think we will get that building filled out. So Vainodes doing fine, no news there. LNK Center is discussing with the tenants also how they view the future. So there may be some changes in the floor areas, but currently these are only discussions, so we're waiting some feedback and ideas from the tenant side. In Sky, everything is working well as well. It's quite interesting to see, from our numbers, the recovery now compared to beginning of last year, when we still had the restrictions and certain limitations, that the footfalls and turnovers across the board in our retail assets has increased 30 to 50%. So I think the numbers, they look astonishingly high, but of course the base was also low, but it definitely shows a strong recovery. And for example, if we look at the month of January from the sales and turnover, sales and footfalls, then everybody was afraid of what's going to happen in January, because it's the slowest month, and Euribor is increasing and all the rest. So it seems that it's very difficult to change people's habits, and at least in our retail assets, the turnovers are increasing, and so are the footfalls. So and what we heard also when discussing with Standard & Poor's, our rating agency, that this is quite similar to what is happening in across Europe. So it seems that people are postponing large ticket item purchases or investments such as apartments, maybe new cars, boats and motorcycles, the like. But they are still indulging themselves into shopping and restaurants, small ticket small ticket items and cafeterias, also traveling. So that's quite interesting to see as well. And maybe last but not least, Lincona has we have one of the larger anchor tenants there expanding again. Some are retracting, some expanding to one floor now, and one additional floor in the coming few months. So we have basically agreed to terms. And Pirita also showing increases in footfall and sales. So from these numbers, maybe just to mention one more time the retail asset recovery. So it's in process. Yes, it's been lower than what we hoped for, and because of largely because of the uncertainty last year. But I think the largest potential this year will be in Galleria Centros, as we are on next Monday on the 27th opening on the 4th floor on 1,500 square meters, a new food hall. We have 600 people invited, including the mayor. And I think with the branding of Burzma and the excitement that we have brought, I think it's going to be a success. So I do invite everybody to visit once it's open. It has outdoor terrace as well on the 4th floor overlooking the old town, and lots of natural light. There was also a question about how do we measure these investments? For example, 2 million invested into Galleria, then for example the IRR that we've calculated from that investment, meaning that we make an investment and get the higher rental income, so it's around 12%. And in Reval Cafes, when we invested roughly 200,000 to redo the 170 square meters of Reval Cafes premises, completely, the rent that we're getting from that location is considerably better than it was before, and the IRR of that project, for example, is close to 20%. So based and that's not even for example in Galleria's case, we do hope that the footfall will increase and that will benefit also the other tenants, and also we have signed a international anchor, fashion anchor in this case for Galleria Center, opening in the second half of this year. So that should bring definitely also a lot of excitement. It's the first expansion of this brand into the Baltics. So we definitely we do see for a recovery of the NOI in our retail assets, but yeah, it has just taken a bit more time than expected. But overall, I think the numbers should speak for themselves. In regards to like-for-like, increase in the NOI, then the change in retail was 23%. So we did have a recovery of the NOI already, and this is last year. So now there was a question about do we have, or are we planning to index our rents? And yes, we have indexed our rents, and we are planning to do so based on the contracts that we have. What these numbers don't show is that mainly in January and February this year we have indexed our rental agreements. Our rental agreements include different types of indexation clauses. Some of them are capped, let's say 3% or 5%, but some of them are uncapped. There is local inflation, there is European Union level EU CPI. So what we are seeing is and what we are estimating is for this year, on average, by indexation, our rents should increase by roughly 8%, 8 to 9%. So close to the EU CPI level. And that is expected to be also visible in numbers now in probably also in the first quarter already, but most likely in the second quarter. So going forward, when we are, just a note here, maybe because of the vacancies that we had in the shopping centers, what impacted the results last year was also the surcharges and especially energy costs that we were not able to charge the tenants. So in that sense, when the vacancies are being filled with new tenants now, we also get the coverage of some of these utilities costs. So that should have a positive, double positive effect for the NOI. Then few more words about the food hall in Galleria centers. So we did have a opening actually planned in second quarter, but now we are in time and we are doing it now in the end of February. The question was also that we are investing around 1.5 million euros into the ground floor to bring in this new fashion anchor. And how do we measure the profitability of such an investment? So that is a bit more complex because there in these cases, as in retail, for these top anchor tenants, it is based on turnover rents, and it is based on what we know and what we see, how this brand is doing elsewhere, what sort of sales are they doing, and based on this sort of experience, we're forecasting our returns. But then again, like a food hall will be a destination point, so will be the new fashion anchor. So it's more difficult to measure and calculate to the whole center and to the other tenants. So we do believe there's definitely a positive benefit for that, but that is more difficult to measure. But we're still absolutely confident that this will be a game changer, these changes for Galleria centers in Riga Old Town. As well, mentioned a bit about Postimaja and Reval. Maybe additionally, I would mention that we have taken back the parking and also Basilic premises on the ground floor. So we're planning a new restaurant there. Parking is being operated by Parking, so SNAB, a new parking operator. So that change has been made. And in Postimaja, we have had some vacancy on the second floor, but we're close to actually signing also a brand for that vacancy now very shortly. So currently one can expect an increase in occupancy in Postimaja next quarter as well. So overall, we managed to have higher rental income than in 2021, regardless that G4S was not in our portfolio in 2022 anymore. So the remainder of the properties performed well, and many showed increase in rental income, especially the retail assets that have been recovering. As you can see, of course, the cost of rental activities has been much higher last year, and that's mainly because of the increase in utilities and energy costs. So we see some stabilization in the energy costs, and that's very. I think that's very good for the tenants and for the tenant confidence. And there was also a note that we are aiming to fix our electricity cost for our Lithuanian assets 50% level, and that is expected to happen by mid-year 2023 at around 100 euros so per megawatt hour. So, and I think most importantly, it is green energy that we are using, so solar panels, and so there's an option in Lithuania to choose that. Overall, we finished the year with 4 million profit. The valuations at year-end, as sort of was expected, the valuators reviewed the discount rates and slightly moved the discount rates upwards. Not a lot, but what offset this was higher indexation and higher expectations of rental income in our properties. So, and quite a bit of recovery, value recovery also in our top retail assets. There was also a question on the administrative expenses, and so last year we had quite a bit of administrative activity. Firstly, rebranding of Baltic Horizon, so that increased slightly the marketing expenses and the budget that we normally have, but mostly legal fees and as well consultation fees that were around our Stockholm listing. Now we have converted into a Swedish entity, and or the fund is listed as Swedish depository receipts in Stockholm. So quite a technical exercise in cooperation with Euroclear and Nasdaq Stockholm. So that was the reason of higher expenses. Also, we have a new administrator there for the listing Nordic issuing, and furthermore, of course, preparation for the refinancing of the bond, legal advice, also prospectus related to that, so and so on. So there were, let's say, quite a few specific costs that increased the administrative expenses. The question was specifically as well, what are under other administrative expenses? which is roughly 460,000 euros a year. So those are basically Nasdaq fees, listing fees, Standard & Poor's fees for the rating. Mostly those type of fees. And in regards to the balance sheet, so I think year on year remained relatively unchanged, but yes, I mentioned that we did refinance as many of our loans, and the majority of on the current liabilities, which are short-term financial obligations, a majority of that is the bond. Then financing, and as I mentioned at the beginning, the fund, since the war started in Ukraine and all the aftermath and all the results of that war, has made us focus heavily on refinancing of our loans and also prepare for the bond financing, so that preparation for such event takes quite a bit of time, and also starting from last autumn, we could refinance the bond free of charge. Previously, we had to pay a fee of 1% if we wanted to do it earlier. So things like that to influence these decisions. The environment for the bond refinancing is not favorable, and that is the reason why we're aiming to decrease the bond as much as possible. And when in the previous periods and also during COVID time, actually the bond worked very well for us because of bank loans were at a very low level. Some of the LTVs of the bank loans specifically were around 30-35%. So there was quite a bit of room for any covenant breaches, and we did actually sail through that period quite smoothly because of the low level of bank loans, and even when we were restricted and our shopping center revenues NOI dropped tremendously, even then we hardly broke any covenants, so we were able to go through that period very successfully. And plus, of course, it allowed us to pay quite high dividends during the period. Now the times have changed, so we are moving back to bank financing. As I mentioned, we have increased some of our loans. Some of the loans are not yet withdrawn in, and they will be withdrawn in when the bond refinancing moment starts, arrives. But yet, yes, it's not attractive to have long-term bond financing today for our fund. So we are looking how to reduce that, and one step was selling Europa parking house and also Domus Pro, and potentially there could be one or two other disposals, but so we have sort of various we have plan A, plan B, plan C. We have discussed this also quite thoroughly with our bond investors, and many are willing to participate and prolong. So we just want to arrive at the best possible capital structure for us. And there will be more news about that, of course, in the coming periods, quite shortly now, probably in the second half of March. So currently, in regards to the bank loans, and particularly for this slide, we over the years we've always hedged our interest costs either with so basically this means fixed to certain levels, some 100%, some 50%, and currently our portfolio is roughly 74%, or actually 80% fixed. So that means that we also purchased some caps before caps and hedges became very expensive in late spring, early summer last year. So some of our loans have additional caps, so that in case Euribor goes above 2% or goes above 3%, so there is a ceiling. So that helps us a bit from the interest cost side, and but of course these caps have a term. The term is 24 and 25. So at least for this year, what we will see is probably some gradual increase in our cost of financing, but not very abrupt increase. And of course we will see at what level if one asks, what level we will refinance the bond or partially refinance. We're doing probably a lower bond, then it's difficult to say. It depends on the amount. It depends on the condition in the market at that moment. So but of course it is more expensive than 4.25, which we had as coupon since 2018. So here's a list of our financing partners, and also the loans that we have to be refinanced as well in the next couple of years. So and after we refinance the bond, then the main focus is on refinancing our top retail assets, and LTVs actually of those retail assets are quite low, and we've over the years repaid back some of those loans, and the results are recovering. So we see also positive potential in getting those loans refinanced, but that's only next year in 2024. And before I go into the outlook, let me see if I have some questions. So I think some of it I already answered, but let me just re-summarize that we are aiming to have a lower bond than 50 million and considerably lower, and for that we are increasing some of our bank loans and have sold a couple of our assets. So in regards to the expected rental income for this year, and that we have now sold Domus Pro and will Meraki recover that loss of income, then I believe so. And so I think we have several scenarios, but we are targeting still higher levels than we had for last year. But of course it depends on the environment, and it depends on how high and will Euribor become, and how long it will stay at the level where it will be. So and that is quite difficult to estimate. And currently, there's various views on that. Of course, if you would look on a next 3-year perspective, then I think this year would be where we would see the top level of the Euribor, and probably by the second half of this year we would see more optimism, hopefully. So that's what the markets are also expecting. So I have a few more questions. There was a question that what if Euribor increases, to extreme levels, let's say 5, or let's say 3.5 and 4%, or even 5. Then, as I mentioned, we have still for this year quite a lot of fixed rate hedges and also caps, so that will help us a bit. But what anybody can do in a commercial real estate segment today is index rents and find efficiencies in the cost side as much as possible, and make sure that the occupancies are high, so that the costs are also covered. So that's the name of the game of commercial real estate sector today. In regards to looking forward for the fund, and after refinancing the bond, that will we what are we going to do? We going to expand further? Then yes, we are currently focused on getting the new capital structure in place for the fund, but selling, as we have sold a few assets, but we definitely want to focus on commercial real estate also in the future. And as I mentioned, city centers, newer assets, and possibly as well, a new capital raising by the end of this year, maybe early next year. So definitely we want to develop business further. We believe in the Baltic capital cities, and we believe in the commercial segments. Just one has to be quite smart about today what properties will be more effective and efficient, and where do we see more rental growth, and so forth. So that's currently what we're analyzing quite a bit. In regards to the dividends, and why, and the question there was also why haven't we done any buybacks? So the truthful answer is that again, we're focusing on refinancing the bond, and we see much more value in getting the more expensive bond to a lower amount than buying back our units currently in the market. Yes, they are extremely low, and I think we have demonstrated at least on a few occasions that we don't believe that our assets are valued at 50% to the NAV, which currently the stock market suggests, with G4S, with parking, with Domus Pro. So I think we do have an attractive portfolio, and that even in today's market, which is still quite uncertain, we can make deals go close to the NAV level, and Domus Pro, for example, was sold roughly 5% below the NAV most recent valuation. So we do see potential, and a value in our portfolio. So we, in that sense, yes, we could buy back some units, but after the bond, if really the unit price stays where it is after we refinance the bond, then I think it's a quite a clear clear thing to do, quite a reasonable thing to do. In regards to the dividend, the same answer. The focus is on deleveraging currently and getting the bond at the lower level, and then basically think about the dividend. So the announcement and the discussion on the dividend will be early June. So hopefully, and I do say that that's definitely a goal for Baltic Horizon, for myself, to make sure that we are able to pay also something out for these periods. So let's see, there's some additional questions. I think the administrative expenses topic I covered. Many of them I would consider still one-off expenses related to the listing and the bond prospectus and the rebranding. There's a question specifically, are we looking to dispose more assets? Then yes, we have been on the market to sell some of our assets also previously, and I think there will be, if there will be some news, of course, that will be shared through Nasdaq as it is supposed to be. So, but definitely we are looking to reshuffle some of our assets in our portfolio and divesting some, decreasing some retail, as we did with Domus Pro, and then refinancing our bond, and then the growing the fund further. So. And one question specifically, why the unit price is where it is today, then I think some investors have said that it could be because of the bond refinancing topic, that how will that be solved, and we're solving it now. So I think after the bond is refinanced, it will be also a much clearer picture for the investors, and to see how the portfolio structure and then the capital structure will look like for the coming years. So I think this includes the presentation. So thank you for attending, and if there's any other questions you still have, please feel free to send an email, and we'll try to answer them as we can. So once again, thank you very much. Let's be in touch.